Okay, so um, I have to be honest with you. I was looking at the market data for February 19th, 2026, and I legitimately thought there was a glitch in the system. Like, I refreshed the page 3 times.
A glitch? What exactly were you seeing?
Well, look at Occidental Petroleum, OXY. They released their Q4 2025 earnings report. And if you look at the top line, it's a disaster. They missed their revenue target by nearly $1 billion.
It was a significant miss, yeah. Wall Street expected just over $6 billion, and they brought in 5.1.
Right. And $1 billion is not a rounding error. That is a call the movers and pack up your desk kind of miss. Usually, when a company whiffs that hard on revenue, the stock gets punished. But then I looked at the stock price and it shot up almost 10% the next day, 9.5% to be exact.
It's a fascinating reaction from the market.
It's confusing. Since when does missing your sales goal by $1 billion result in a standing ovation? Help me out here. What am I missing?
It's a great question. And honestly, it's the perfect place to start this deep dive because that reaction tells you that the rules of what investors value in the energy sector have shifted.
Shifted how?
They have stopped looking strictly at the top line revenue, how much money comes in the door, and they have started obsessing over efficiency, specifically how much cash you actually get to keep.
Okay, so we have a pretty clear mission for today then.
Right. We are looking directly at the transcript from OXY's earnings call. This is with CEO Vicky Holub, CFO Sunil Matthew, and COO Richard Jackson, along with the press release and their slide deck.
And what we are trying to figure out is how they're spending less money while producing record amounts of oil.
Exactly. What we are seeing isn't a revenue story, it's a transformation story.
So we are talking about a company that is shrinking to grow.
In a way, yes.
Okay.
They've spent the last decade shedding weight. They sold off the OxyChem business. They paid down a mountain of debt. And now they're presenting themselves as a lean, mean, cash-generating machine.
Well, let's look at the cash then. Because even if the revenue missed, I did notice the earnings per share was a beat.
A massive beat. They came in at an adjusted 31 cents a share versus the 18 cents everyone expected. But the real story here, the number that actually matters to the people holding the stock, is free cash flow.
I hear that term constantly. Free cash flow. Define that for me in this context. Is this just profit or something specific?
Think of it like this. Revenue is your gross paycheck. It looks impressive on paper. But free cash flow is what is left over after you pay the mortgage or the car payment, the utilities, and buy the groceries.
Got it. It's the money you can actually do something with, like put in savings or buy a new TV.
Exactly. It is the discretionary funds. And for the full year 2025, despite oil prices dropping about 14% compared to the year before, OXY had generated $4.3 billion in free cash flow before working capital.
Wait, hang on. Oil prices went down significantly, and they still printed over $4 billion in extra cash.
That is exactly why the stock jumped. It signals extreme resilience. The market realized OXY doesn't need oil to be at $100 a barrel to make money.
They can be incredibly profitable even when the market is soft.
Right. They fundamentally changed their cost structure to survive and thrive in a volatile market.
That feels like a massive safety net. But where is that efficiency coming from? You can't just wish for more cash.
A lot of it comes from their balance sheet makeover. They have been on what you might call a severe financial diet. You remember the Anadarko acquisition a few years back?
Vaguely, yeah. That was the really big controversial merger, right?
Huge. And it saddled them with a mountain of debt. It was the elephant in the room for years.
Yeah.
But look at what they have done in the last 20 months. They have repaid $13.9 billion in debt.
Almost $14 billion in less than 2 years. That is so aggressive.
It is incredibly aggressive. Their principal debt is now sitting at $15 billion, and they just launched a tender offer to knock that down to $14.3 billion.
They basically cut the mortgage in half.
Yeah. And I want to point out a note from their CFO, Sunil Matthew, about the maturities.
Which sounds technical, but it's basically just when the bills are due right.
Correct. And this is the best part for them. Because they paid down so much so fast, they have almost no debt coming due in the next 4 years. Only about $450 million.
For a company this size, $450 million is basically loose change found in the couch cushions.
Essentially, yes. So they aren't scrambling. They aren't stressed about refinancing. And because they aren't stressed about paying the bank, they can pivot to paying the shareholders. They announced an 8% increase in the quarterly dividend.
Which is nice. Everyone likes a raise. But I also saw something about share buybacks that confused me a little. Usually companies just say they're buying back a certain amount of stock immediately.
Yeah.
OXY was a bit more cryptic. They mentioned an opportunistic strategy aiming for August 2029.
Yeah, this is a really interesting strategy detail. So OXY has preferred equity on their books.
Unpack that for us. What is preferred equity?
Think of it as a special class of expensive stock that pays a very high guaranteed dividend. It is expensive capital for OXY to keep around. They want to get rid of it.
So why don't they just buy it back right now?
Penalties. If they try to redeem it too early, there is a premium they have to pay. But in August 2029, those penalties drop off. It becomes much cheaper to call that equity.
Ah, okay. So
Um,
they are hoarding their firepower.
Exactly. They are going to do opportunistic buybacks now, but they are really saving their allowance for 2029 to make a massive move and clear that expensive equity off the books entirely.
Playing the long game. I like it. But okay, the bank account looks good, the debt is down, but you can't financial engineer your way out of the fact that you are an oil company. You eventually have to dig holes in the ground and find the black stuff.
You do. And this brings us to the operational side, which is arguably even more impressive than the financial side.
This is where the transcript got really weird for me. OXY set a production record in 2025. They pumped 1.434 million barrels of oil equivalent per day.
A massive number.
But they spent 300 million less than they planned to. And looking at the 2026 guidance, they plan to cut capital spending further, down to between 5.5 and 5.9 billion. But they still want to grow production by 1% to about 1.45 million barrels a day.
Right.
How? Are they using magic wands? How do you spend hundreds of millions less and get more oil?
It is not magic, but it is some pretty serious engineering. COO Richard Jackson broke down the mechanics of this efficiency. He calls it development efficiency.
Which sounds like corporate speak for we're just working people harder.
I know it usually is. But in this case, it is actually about drilling smarter, not just faster. For starters, their new well costs dropped 15% in 2025.
Okay, how did they manage that?
Let's look at something called simulfrac.
Simulfrac. It sounds like a Decepticon or something out of a sci-fi movie.
It stands for simultaneous fracturing. Picture a traditional oil field. You drill a well, then you bring in the fracking crew. All of those trucks, the pumps, the sand, the water, they frack that one well. Then they have to shut everything down, disconnect the hoses, pack up, move 50 yards to the next well, and set it all up again.
That sounds like a lot of downtime.
Tons of downtime. And while that equipment is sitting there being moved, you are still paying rental fees on it. It is non-productive time.
Okay, so how does Simulfrac fix that?
With simulfrac, they are increasing the number of wells per pad. They went from 3 or 4 wells up to 4 to 6 wells side by side, and then they hooked the equipment up to multiple wells at the same time. They pumped sand and water into them simultaneously.
So it is like filling 3 gas tanks at once instead of waiting in line for the pump.
Exactly. And the efficiency gain is wild. In 2025, OXY went from using this technique on 10% of their wells to nearly 40%. It saves days of operational time and millions in equipment rental.
That makes total sense. You just stop wasting time moving trucks around. They also mentioned something about lateral lengths increasing by 10%. Translate that for me.
So modern oil wells go down vertically, and then they turn sideways, horizontally, to run through the rock layer where the oil is. That horizontal part is the lateral.
Okay.
OXY is simply drilling those laterals 10% longer. Think of it like a milkshake. If you have a longer straw that reaches further across the bottom of the cup, you get more milkshake without having to poke a new hole in the lid.
I love a good milkshake analogy, so they get more oil without the cost of drilling a whole new vertical shaft.
Precisely. It maximizes the asset.
Yeah.
But honestly, my favorite anecdote about this efficiency wasn't the drilling. It was the storm. Did you catch the bit about winter storm, Fern?
Yes. This is in the Rockies, right?
Right. So oil fields in the Rockies are tough environments. When a massive blizzard hits, we are talking sub-zero temperatures and blinding snow. Typically, everything shuts down.
Why? Just for safety.
Safety is huge, obviously, but also mechanics.
Mm-hmm.
Pipes freeze, sensors fail, valves get stuck.
Ugh.
And it is way too dangerous to put a human being in a truck to go fix a valve in zero visibility on an icy road.
So normally production drops to 0 during a storm?
Right. It is expensive downtime. But OXY has invested heavily in these remote operations command centers. It is like a control tower for the oil field located miles away in a warm, safe office.
So they are not even on site.
No. And during Winter Storm, Fern, the team in the command center was resolving 300 issues per day.
300 undocumented issues.
per day. They're opening valves, resetting sensors, rerouting flow, all remotely, like playing a video game, but the game is a billion-dollar infrastructure project.
That is wild.
They kept the oil flowing when competitors might have had to shut down. That isn't just efficiency. That is a competitive advantage. If you can stay online when the shop next door is buried in snow, you win.
It is amazing how much this industry has turned into a tech sector. It is automated, it's precise, and it's remote.
It really has.
Okay, so we have the money, right? We have the operations humming, but I want to zoom out because CEO Vicky Holub said something toward the end of the call that honestly it spooked me a little.
You are talking about her macro warning.
Yeah, she is cautious about 2026 prices despite current geopolitical spikes. But then she started talking about 2027. And she warned about a global oil supply crunch. Now I feel like I hear this every few years from oil CEOs. Oh, we're running out of oil, prices are going up. But then someone finds more oil in Guyana or somewhere, and we are fine. Is she crying wolf, or is this real?
She doesn't think she's crying wolf,
Oh.
and she brought the data to back it up. Her argument centers on something called the reserve replacement ratio.
Okay, break that down. What is the replacement ratio?
It is simple supply chain math. If you sell 100 cans of soup from your grocery store shelves, but you only order 25 new cans to replace them, what happens to your store?
Eventually, you have empty shelves and hungry customers.
Exactly. Vicky pointed out that the industry-wide reserve replacement ratio is currently less than 25%.
Wait, the entire industry?
On average, yes. Most companies are producing far faster than they are finding new oil. They are liquidating their inventory to keep stock prices up and pay dividends, but they aren't investing enough in exploration to replace what they pump out.
But what about those big discoveries you mentioned? Guyana, Namibia. I see headlines about those all the time.
Vicky addressed that specifically. She said, look, those are great. Maybe 12 billion barrels have been found there recently. Sounds like a lot, right?
12 billion sounds huge.
The world consumes 30 billion barrels a year.
Oh.
Yeah. So that massive discovery doesn't even cover 6 months of global demand. Vicky's point is that the math simply doesn't work. By 2027, she believes we are heading toward a supply shortage where the world simply won't have enough oil to meet demand.
Which brings us back to OXY, because if everyone else is running out of soup cans...
And you have a warehouse full of them, you're in a very good spot.
So what does OXY's warehouse look like?
It is full. They stated they have a resource base of 16.5 billion barrels of oil equivalent. They claim that gives them 30 years of low-cost inventory.
30 years. That is a generation.
And here is the golden stat you need to remember from this section. 84% of that resource breaks even at less than $50 a barrel.
So even if the price crashes, they're still making money on almost all of it.
Correct. And unlike the rest of the industry, with that scary 25% replacement ratio, in 2025, OXY achieved a 107% organic reserves replacement ratio.
So for every barrel they sold, they found a barrel and a bit more to replace it.
Exactly. They aren't running out of oil. They're growing the tank while everyone else is draining theirs.
They also mentioned something called GOA 2.0, Gulf of America. Is that just the Gulf of Mexico?
It is. But they are rebranding the strategy a bit because they are implementing these water sled projects, specifically the Horn Mountain project starting in late 2027.
Water flood. Is that exactly what it sounds like?
Pretty much. As you pump oil out of an underground reservoir, the natural pressure drops. Eventually, the oil stops flowing. A water flood involves injecting water back into the reservoir to pressure it up and physically sweep the remaining oil toward the wellbore.
Like squeezing the toothpaste tube from the bottom to get that last bit out.
A very high-tech version of that, yes. And this lowers the natural decline rate of the wells. They expect the Gulf of America decline rate to drop from 12% down to below 7%. So they aren't just finding new oil, they're getting way better at extracting the old oil.
Okay, before we wrap up, we have to touch on the future. Because OXY isn't just drilling for oil anymore. They are famous for their bet on sucking carbon out of the air.
The low-carbon ventures.
Yes.
Specifically Stratos.
Right, Stratos. This is their direct air capture facility. Where does that stand? Because I know this has been a cash drain for a while and investors get nervous about science projects.
It has been a significant investment, yes. But they have an update. Phase 1 is coming online in Q2 of 2026, and Phase 2 commissioning follows shortly after.
Oh, wow. So it's actually happening.
It is. But the really interesting note in the financials is that investment in low-carbon ventures is actually dropping by $250 million this year as construction winds down.
Because they are finishing the build.
Right. They are moving into operations.
Yeah.
And they laid out their future strategy, which is to look for partners for future DC hubs to manage the capital risk.
Smart. De-risk it by bringing in outside money.
Exactly. Prove the tech works at Stratos, show the economics, then get someone else to help pay for the scale-up. They have an expectation of levelized EBITDA from Stratos of $90 to $130 million by late 2028.
So it goes from a science experiment to an actual business line with a profit margin.
That is the plan.
All right, we have covered a ton of ground here. We have the financial turnaround with the massive debt repayment. We have the operational alchemy, doing more with less. And we have the 30-year inventory while the rest of the industry is running dry.
To summarize, OXY has successfully transitioned. They are no longer a company trying to digest a massive acquisition. They are a streamlined operator.
If you had to boil this entire deep dive down to one single number, one thing for the listener to take away, what is it?
It has to be the sustaining capital stat.
Yeah.
CFO Sunil Matthews stated they can keep production flat with just $4.1 billion in spend.
$4.1 billion to keep the lights on and the oil flowing.
And here's the kicker. That math works even if oil drops to $40 a barrel.
That is their safety net.
It is a fortress. They have built a company that can survive the worst days and absolutely thrive on the good days.
And I want to leave you with a final provocative thought to mull over. Vicky Holub pointed out that most of the industry is failing to replace the oil they produce. The replacement ratio is less than 25%, but OXY is replacing 107% of theirs.
Right.
If the 2027 supply crunch that Vicky predicts actually comes true, is the market currently undervaluing the sheer security of OXY's 30-year inventory?
It is a question every energy investor needs to be asking right now.
A leaner, faster, and more efficient company. Just a reminder for everyone listening, this deep dive was based on the OXY Q4 2025 earnings call from February 19th, 2026. Keep learning out there.
Thanks for having me.